Welcome back to Smart Money News Fresh Minds. I'm Wesley.
And I'm Joe. Today we're talking about something every investor needs to understand. There's no free lunch in finance.
Higher returns require higher risk. And sometimes the best way to plan ahead is to look at some of the largest investment managers expect from the future.
What no free lunch really means. Investing isn't magic. You're compensated for risk. The stock market rewards you over time, but it doesn't promise anything in the short run.
Some years are amazing. Some years test your patience. But if you expect high returns without volatility, you're not investing. That's a fantasy. And what's really important there is that everyone likes to talk about a 10% return a year, 12% return, blah, blah, blah. That is an average over the past 50 or 60 years. They're not talking about what can happen next year. We could have a market correction and go down 50% next year. Granted, how close you are to retirement and when you're going to stop working is really important when we're looking at this, because there is no guarantees.
Now we're going to look at the three largest asset managers in the world. We pulled the forward-looking capital market assumptions from BlackRock, Fidelity, and Vanguard.
And guess what? They're all expecting lower returns for U.S. equities going forward than what we've gotten over the last decade.
If we look at BlackRock, they're assuming over a 10-year time period, 5.2% return. Fidelity, over a 10-year time period, is looking at 5.8%, but at their real return, they're looking at a 3.2%, factoring inflation. And Vanguard, they've adjusted theirs to even lower, a 2.8 to 4.8 over the next 10 years.
That's a far cry from the 10 to 12% people like quoting from long-term history.
And why are expected returns lower, or forecasting that they're going to be lower over a 10-year time period? You have to look at elevated valuations in the U.S. stock market. You also have to look at the Fed fluctuating interest rates, changing discount rates. You have to look at potentially slower expected economic growth. And we can also look at concentration of returns in mega cap tech stocks, or also returning to the Mag 7.
Now, what we're saying here, it's not all doom and gloom. It just means we shouldn't build financial plans assuming the highs of the last decade will automatically repeat. And we believe, time in the market is better timing the market. But we have to be realistic in what we see for the future and plan accordingly.
Here's the important part. And what should investors do now? Lower expected returns doesn't mean stop investing, because we don't have a crystal ball. We can't tell you what's going to happen. And if we did have a crystal ball, frankly, Wes and I wouldn't be working here. That means be smart about diversifying your assets, whether that's hard assets, gold, silver, land, your risk allocation within your current accounts, having some global exposure, and alternative income sources.
Well, to Joe's point, I wish I did have a crystal ball, because then I'd be drinking mojitos on a private island with my yacht parked out back. But we don't, and here we are. But getting back to it, clients who expect to have too much run the risk of overspending now, undersaving, and outliving their money. And by that, if you expect to, make 20% a year over year, you're going to say, oh, I don't need to allocate any more money. And I'm just going to, spend it now because I'm going to make it later. I don't need to save money. And then when those expectations don't come true because they have outlandish goals, they end up outliving their money.
And to Wesley's point, we'd rather have you pleasantly surprised, not blindsided.
Now, let's sum all this up with a little hypothetical. Let's meet Denise. Denise is 55 and planning to retire at 65. Her old plan assumed 9% returns every year.
Now we've updated her plan using one of our risk tools, and we added some pessimism there. And we're using 5.5 expected returns, and it reveals her nest egg won't last through her full-time retirement timeline. With small changes today, slightly boosting savings, delaying a year, or adjusting spending brings the plan back to success.
That's right, Joe. And this is why expectations really matter. Plans must evolve with reality and not rely on the past.
And this comes back to, we need to see your whole financial picture to give you the best plan possible, not just looking at your investments. There's no free lunch. The market will reward you over time, but you have to respect risk.
And build a plan based on forward-looking data, not hope.
If you're not sure whether your expectations and investments line up with reality,
we're here to help. Reach out to us at Black Diamond Financial Solutions, and let's make sure your plan is prepared for the next decade and not the last one.
Thanks for tuning into Smart Money News Fresh Minds. Again, if your advisor is not doing a review meeting with you to look at the forward-looking assumptions of the market, Wes and I would be happy to go over this with you and show you what the data shows, also factoring past returns, but also looking at, hey, how you're suited today and how you're going to look forward.
Also, be sure to follow the show, and we'll see you guys next time.